So welcome all. I'm David Farrell. I'm the founder, managing director of FinClear. To set the agenda today, we'll run through the formal AGM meeting, which will be immediately followed by a shareholder update and a Q&A session. In the meantime, I'm just giving an apology for David Hancock not being able to be here in person. Unfortunately, David has contracted COVID and working from home. But he would like to give a short chairman's address. David, over to you.
Thanks, David. Yes, thanks. I do apologise. And it was actually quite welcome to have the AGM because it forced me to get out of bed. Because I think anyone who's had COVID, unfortunately, this is the second time, and I've just spent 4 days in bed, which isn't very pleasant. But listen, it's with great pleasure that I'm here talking about quickly the 2022 results and just giving you a quick overview about the way that I see the performance of FinClear on behalf of myself and the board. It's been a really milestone year, and I know that a lot of companies use that word milestone or seminal, but the reality is it's been a transformational year for FinClear. We've been able to bed down the massive acquisition of Pershing. There's one thing to aspire to acquiring something over a long period of time. It's another thing to actually do it and to actually then drive the benefits through. And I think that, you know, most mergers always look good on paper, but the reality is it's when the rubber hits the road, when new people join offices, when you change brands, when you work with customers to see whether value has really been created. I think it's quite clear that significant value has been created for the shareholders of FinClear, but also real value has been transferred to our clients, which obviously at the end of the day, that's a really important measure about the success of anything. And we measure that through things like customer satisfaction. And what we've seen is our engagement with our new customers and our new staff has gone up significantly. So from all the metrics of financial and non-financial, I'd say that the word milestone is an apt word. And it's something that David will talk about. The second thing is that FCX, which we'll talk about, and which is very topical, which is really reimagining the way that private companies think about their registers and the way that they can run capital. We think that despite the fact that there's been a lot of noise in other sections of distributed finance and within ledger technology, we're in a space that proves that technology can really drive value and can really work. And FCX is a testament to that. And we've got real examples of that David's going to talk through. I think the last thing that I just wanted to say is, I want to say, obviously, a big thanks to our shareholders. I mean, it's obviously been a very difficult time for most people if they've been active in equity markets, but also private markets. I think what you can be assured of is the way that we run our business. We run it as owners and we run it with a sensibility that we've got a responsibility for you as shareholders. And I think hopefully that you're going to see that through in some of the points that David's going to elaborate. So I just want to say, obviously, thank you to you for coming on this journey, this ride with us, but also the staff and the leadership, especially under David. I think it's been a real testament that we've got really great leaders in place. They've been really demonstrating their worth through difficult times. And it's been really encouraging to see the results that we've actually delivered. So what I'm going to do, I'm going to hand over to David and look forward to, if there are any questions, happy to answer those from the safety of my Zoom.
Thank you, David. And just a point of note, we are obviously operating remotely today via Zoom. It's my expectation that probably we'll be coming back to physical meetings, I suspect, next year. So just some formalities that we've got to run through. I note that we have a quorum present for this meeting, and so the AGM is open. I would like to start by introducing the board. On the call today, we obviously have our chairman, David Hancock. We also have Chris Harris. We have Tracy Ahi. We have Alex Ferguson. And we have an apology from Chris Barter. Unfortunately, Chris is travelling on a plane today and couldn't join us. So the notice of meeting was circulated to shareholders on the 27th of October, and we're going to take the notice of meeting as read. You may have noticed the notice of meeting. There were no resolutions to vote on at today's meeting. As this shareholders meeting, this is a shareholders meeting only. Their attorneys, proxies, authorised company representatives are entitled to speak at the AGM. However, I do note there will be an opportunity for a more general discussion as part of the shareholder update. So, of course, feel free to submit questions either online or at the end of the actual presentation. We give more around business update. The first item of business contained in the agenda for today is consideration of the financial statements of the company, and obviously receive financial statements, directors' report and auditors' report for the company, its controlled entities for the year end 30 June 2022. Again, we're taking them as read. Are there any discussions or questions in relation to the financial statements? We will, of course, be going through in the update some of the balance sheet and financials. But are there any questions in relation to the auditor's report and financial statements for 2022?
I think John McMurtry's put his hand up. John, I think you can speak, John.
Because remember, Tracy said that they're worried about directors' insurance, that they'll come to that. I have no interest in that.
John, I think you're coming through very faintly. We can see you speaking, but can't quite hear you.
Protecting themselves, thinking they come. If they admit to this, then obviously there's other stuff to worry about. I think
you can also submit it in the chat, John, and we can collect it there.
But guys, sorry, that it seems like we're having a lot of difficulty hearing anyone asking questions. Perhaps if you have a question, please submit it via the chat in the first instance, and we'll open up to Q&A perhaps at the end of the presentation. So we'll just wait to see if any questions come through in chat to start with.
Yeah. Okay. Yeah, I spoke to another lawyer today about the other part of it as well.
Can we ask Jackie Moore and a couple of other people to put their Zooms on mute? We can hear your private conversations.
Yeah. Thank you, everyone. Again, please mute your microphones. Guys, like I said before, I'm hoping this is the end of Zoom meetings, particularly for AGMs next year. Yeah. We can hopefully move to an in-person.
No questions have come through.
So we've had no questions come through. There may well be, giving everyone the opportunity to ask questions at the end of the update. No further discussion. I'll move on to the next item of business. The second and only other item of business is to consider any other business brought forward in accordance with the company's constitution or the law. So is there any other business? Anything that anyone would like to table? Again, please come through via chat. Okay, so nothing through. That now actually concludes the formal matters. And
Let me bring it up on the screen.
so we have a question actually from John McMurtry that's just come through. The Pershing acquisition for which $1 was paid led to a profit being the book value of Pershing. This gives a misleading view of the company. So how about Natasha talks to that quickly, John, for you.
Hi, John. So you're right. In our financials, we have booked a what is referred to in the accounting standards as a bargain purchase gain, where the net, the fair value of the net identifiable assets of a company exceed the consideration paid for those assets. There is a bargain purchase gain. I can assure you that the accounting treatment of this has been looked over in great detail by our auditor KPMG, and also, in fact, by the auditor of one of our largest shareholders. So I'm comfortable with the treatment is in line with accounting standards, and hopefully the fact that it's called out there separately allows the users of our financial statements to understand where that's come from. Good. I also have full confidence in it, so that's good to hear.
So we've been quite clear in terms of even the tagging it is as a bargain gain and not a recurring or not expected.
Correct. And it's out there on its own line for that reason.
Yeah.
Thanks for your question.
Thanks very much, John, and thanks for your confidence. Okay, we've had no other questions come through, so that concludes the formal matters. We'll declare the AGM closed, and we'll probably move on to the more interesting parts that I think everyone has dialed in for, in terms of giving a bit of a business update. So I'm going to run through this fairly quickly, and then happy to have some Q&A at the end of that. Again, feel free to submit questions via chat, or if you'd like to come off mute. And if we can hear you, we're having a few problems here with the AV. We'll attempt to answer those questions. So let's get into it. So firstly, as David alluded to, or David pointed out in our chairman's address, thank you. A very significant milestone has been achieved with the successful integration of Pershing Australia. It was a big task, a massive task, and we have now pretty much consolidated those business. From a revenue perspective, when we flagged this at the end of last year and actually looked at on a consolidated basis what the revenue might be, we thought it would have been closer to 50 million. The audited result is 46.4 million. And that loss is pretty much wholly attributable to market conditions. Obviously, second half of the year, market conditions were nowhere near the previous year. So that was somewhat disappointing from a market conditions perspective. In terms of what we call corporate cash, we maintain a very strong position, circa $150 million, and later in the balance sheet we'll give you a look at what that is. But circa $150 million with no debt. It's important to note we have very strong ongoing support for ANZ around our intraday and overnight facilities. And that includes support for our FCX initiative. And I'll be talking a bit about that in the presentation later as well. Commercial progress additionally has been very strong. We expected cost savings through the Pershing integration, and we expect more will come. The big news today is obviously around CHESS replacement and what's going on there. Given that only came out an hour or two ago, it's fair to say, we have obviously to digest that news and work out what it means. but we've been very clear that we have additional costs that we are absorbing up until it becomes clearer what the pathway looks for CHESS replacement. So we'll be coming back to shareholders, we suspect, before too long around that. The FCX FinClear Exchange, or FCX, is now launched and active with additional technology features being delivered, and I'm going to run through where we are with that and some of the key milestones in a slide later. And our data strategy is progressing very well, and we've also welcomed Tracy Ahi to our board to actually oversee and run much of that strategy, which is progressing well. Final point, we have implemented cost reductions in response to market conditions. Obviously, it's always sad when we have to make these sorts of reductions, but we think it would be remiss of us as a business, and we'll point to some numbers later, when we see a market downturn and market conditions deteriorating and volumes in the vicinity of down 20 to 25%, it would obviously be remiss of us not to react in terms of the cost side of the equation. So regretfully, over the past few weeks, we have made some significant cost reductions across the business. We'll just go to the next slide, and here sort of look into a bit of a look at two points I want to call out here. First, bottom left, underlying EBITDA, showing a loss of a little bit over $4 million for the year. In context, previous year, $1.3 million. I'd like to put that in the perspective of rewind to this time or earlier last year. FinClear itself, pre-Pershing, was moving to a profitable position. We had been building the business for 5-6 years, and we were slowly getting market traction and share, and we'd actually had the odd profitable month prior to Pershing acquisition. Obviously, the context is we acquired Pershing, which is losing $15 million a year. So in actual fact, a result consolidated over first year of operation of bringing that loss pretty much from $15 million into $4 million, and then putting that again in context of the second half numbers being particularly weak, and we'll talk through that. I'm actually very, very proud of that result. I think it's an outstanding result, and I think it demonstrates to what David was saying before as to how successful the integration approach has been. The second point on this slide I want to call out is, if you look across to the bar graph on the right, you can see the breakdown. But if you look at FinClear for FY22 at $15.3 million, and then you look at it, the 22 numbers, you can see that FinClear on a standalone, obviously we've brought in Pershing, which brings $26 odd million of revenue, but we've continued to organically grow the core FinClear business. And obviously that's a 30% uplift on our core organic growth. And so again, I'm incredibly proud of that, given the context of what we've had to do. Not only have we had to consolidate a big business in and go through a lot of disruption and a lot of changes and change in technology and consolidation, and actually lead a successful integration process, but at the same time, we have managed to organically grow our revenue from the core business by 30%. And I think that's an outstanding result. We'll move to the balance sheet quickly. And again, there'll be questions at the end of that. Really, there's only one thing to call out here from a balance sheet perspective. I know there may be some questions at the end, but it's the top three lines. If you look at those: cash at bank, ASX cash, market margin, collateral held at banks. If you add all those up, it equates to that $115 million of cash that we hold as a business. It's a little bit confusing because obviously we have to hold regulatory capital and we have to hold capital for liquidity purposes as well. But when we look at this, we look at it from the perspective of, well, if we decided tomorrow to close this business down, which we obviously have no intentions of, but if we were to close this business down tomorrow, we would have $115 million of cash with zero debt, and that would be a cash distribution, obviously, to our shareholders. We'll have some Q&A, no doubt, later in terms of the balance sheet. We'll move on to priorities for 2023, and it's quite simple. We have three main priorities across the business: FCX, data, and technology, and they're pretty much in that order. And this is sort of a little bit where I get to talk about FCX and what we're doing with FCX. We continue to expand the tech capability of FCX. The cap table's now in production. We're onboarding clients. We've embedded real-time cash. That lets us do atomic trading and settlement one piece. Removes the concept clearing, and we have cap raising tools. So I'm going to take that all as read. But what I do want to talk about briefly is why we have gone about this before we move to some of the other points. We obviously only came out in April of this year with this initiative launching to market, but we had been building for some time prior to this. So even when we raised capital in September, October of last year, we were 6 months into building FCX, and we knew it was a significant initiative for the business, but we could not talk about it at that previous capital raise. What I can tell you now is that we spent a lot of time looking at this. Why are we doing FCX? Well, first and foremost, or firstly, it's a solution to a problem. It's a problem that you, our shareholders, have been telling us about for some years. And that is that private companies do not have a platform or a capability to centralize and put efficiencies into the process. We knew that because as a private unlisted company, whenever we raise capital, it's been a horrible series of events, from working with a registry, a corporate advisor, a bank, a company secretary, basically shuffling paper around for weeks, if not months on end. And all our clients, including VCs, PEs, high net worths, family offices, all told us, if you build a solution for this, we want to put our portfolio companies on. And so we were aware of this opportunity for some time. However, that wasn't probably good enough to implement from a core position of what we do. Remember, we are a markets business here. We service listed markets. So really, what do unlisted or private markets have to do with publicly listed markets? Well, what we're doing is developing into distributed ledger technology into DAML through the CHESS replacement project. And so we're getting a significant amount of DNA through that. And we looked at the capability for us to build a new and a more efficient exchange and clear or settlement capability. And we looked at how that technology could extend more broadly into our business over time. And we saw dual benefits here. Firstly, there is a commercial opportunity. We can provide a solution to a known problem. But secondly, and more importantly, the technology that we will use, if used in the right way, can build a far more efficient market ecosystem, and we can apply that technology to our everyday business over time, and we can be seen as leaders in this space. So it's important to note that one, we looked at this from a commercial perspective, but we also looked at it from an advancement of the business and our technology capability and enhancing our listed markets clearing and settlement capabilities over time. And I think given the announcement this morning from the ASX and the CHESS replacement and what's been going on there, I think this is actually a very timely and opportune moment for us to talk about what a correct implementation of this technology looks like, because FCX is how you apply this technology. And I think in the coming days and or weeks, we will be getting a fair amount of airplay on that. So look, a couple of things that come out of this, the commercial case for FCX that I talked to, that opportunity is now being realised. We're onboarding clients today and we're looking at deals to execute today. By the end of calendar year, we are committed to having 30 corporates on platform. And by the middle of next year, I think that could be as many as 100 corporates on platform. We have an incredibly strong pipeline being presented to us by you, our shareholders. So VCs, PEs, high net worths, family offices, all showing us opportunities. And we're also partnering with one of the largest accountancy firms, technology firms in Australia that sits over a very large number of unlisted public companies. That's a BGL that's involved in this initiative as well. The second piece to this is we've delivered, or we're in the process of delivering phase 1 and 2. Phase 1 was capital raise, was management of a cap table, a share registry function. That's done, that's delivered. Everyone should have their own digital wallet, be able to see that digital wallet and their shareholding on platform. And we're continuing to onboard corporates. The next phase was around putting automation of capital raising functions into the platform. So they're all the pain points and the paper shuffling pieces that we've been talking to, and that Dean, as our company secretary previously and head of FCX, with day-to-day experience, has been implementing. Those tools today are in test and due for release. The cash component is in test and due for release as well. This is a big piece. Cash on ledger, tokenized cash on ledger is a big initiative. I spent the best part of a month traveling around July, and I was in Europe with Steve McLean as well. We've spoken to counterparts in Europe, the UK and the US. And we are a world first here. There is no one coming from our position of being a regulated at scale markets business that has this sort of capability. So we are today receiving inbound requests for information from very large counterparts offshore, including large exchanges, asking us how we've implemented this, what our solution is. Is there an opportunity? Are there opportunities for us to take this internationally? And so there's some of the questions that we are asking ourselves at the moment. So to reiterate, we're live, we're onboarding corporates, we're delivering efficiencies around capital raising tools. We are delivering cash on platform, and on Monday, we will be doing a live demonstration of a real life transaction where I will personally subscribe to some shares in one of our corporates on platform, demonstrating real life cash coming in, tokenized, hitting my wallet, and then investing into a new company sitting on platform. We'll be getting out invites to that in the coming days, because that is going to be a big milestone, and it's receiving significant attraction from local counterparts, from media, and from other big offshore counterparts as well. The final piece that happens around this is what we call moving to an actual marketplace. It's intended that the market will be what we call a professional and sophisticated market only. Not available to retail investors unless those retail investors are selling existing ESOP or share allocations. So this is what's called a tier 2 market. To be clear, there are no tier 2 securities exchanges in Australia. We will be potentially the first tier 2 sophisticated exchange in Australia for public or for non-listed companies. We have our license application in. It was submitted to ASIC last week. We've had a preliminary meeting with ASIC. David Hancock and myself have met with ASIC, and that preliminary meeting went very well, albeit ASIC will adhere to a timeline that will be significantly dutiful. Let me put it that way. So we have suggested it wouldn't be unreasonable to have a license application completed by middle of next calendar year. They've indicated to us that may be a little bit aspirational. So what will the marketplace look like? The thing to talk about here, it's not going to be a continuous marketplace like the ASX. It'll be what we call an event, periodic driven, or what I call liquidity on demand, where a corporate comes on board. And remember, the intent of doing this is allowing corporates to remain private longer and not have to go into an ASX continuous disclosure and trading environment, which we know is very problematic from both a regulatory disclosure and also from a cost perspective. And so what our market will look like will be an on-demand liquidity event where the corporate can schedule a liquidity event. They can say, I want to have a liquidity event once a day, once a week, once a month, might only be once a quarter, it might be half yearly, or it might even be once a year after an AGM. When the markets are cleansed, when we have symmetry of information and all our investors are able to deal on an equal basis. So moving away from that continuously traded market that gives you continuous disclosure requirements. So a corporate, ourselves, for example, could say, okay, we know there are buyers and sellers. We know that there's demand for FinClear shares at the moment. And we also know that there are some shareholders that perhaps might look at a liquidity event. So we've just cleansed the market. We've shown everyone our financial position, and we've talked about what the future's holding. We've given some guidance. Let's now have a liquidity event this time next week. And so what we do is we'd head into a book building process on platform, and there would be the capability for a liquidity event via an auction or a book building process next week. That's the style of mechanism that we're envisaging with a tier 2 market license. It's important to also say that everything that we're doing at the moment, we can do. So registry fits within our current regulatory licensing. Being able to facilitate primary and secondary transactions as an arranger, we can continue to do. What the exchange lets us do is allow two investors peer-to-peer trade on market. So we can do everything that we're currently doing and have been doing, but that capability for investors peer-to-peer to come on platform and see, well, I'm a shareholder in FinClear. I can see there are these other 10, 20, 30 companies over there, and I can see that 3 of them are raising capital, and one of them I really like, and one of them's having a liquidity event, and I can participate in that peer-to-peer. without any intermediaries on platform. That's what the exchange will facilitate. Okay, so second priority, that was very long-winded and I apologise for that, but obviously FCX is our big initiative and it's important that we spend a little bit of time on that and hopefully there's some questions at the end of this. Second initiative is data. We do want to be a data-led business. We have 3 tiers to our strategy in order of priority. Internal data generation reporting to improve all facets of the business. In other words, internal data generation reporting is a priority for us to enable better reporting and analytics of our own business and enable us to retire some of our existing infrastructure. We do run some old infrastructure, shock horror. We do have some data warehouses that are very long in the tooth and we need to retire. Tracy has been running this process or this initiative with the group for some time. We've recognised this. And the thing to also call out about this is that this is almost a self-funding project. By retiring many of our old heritage architecture enables us to self-fund this project over time. Now, obviously that's important, but we want to get benefits out of it from the business ourselves around identifying new opportunities, being able to look at our business and particularly from a P&L perspective and identify which clients are profitable and which aren't, or which initiatives will be more, generate better returns than other. So that's the priority for us. That's what I'd call, you know, the key pillar. The second pillar, however, is around the clients, client attraction and retention. We think that by having capability to analyse data better and provide that to clients will do 2 things. Enable us to attract new clients to platform because we will be seen as a source of very broad data in this area. And then being able to retain current clients is obviously important as well. Now, obviously, we haven't had too many problems on client retention. One of the great benchmarks for us is that we have had very, very low client turnover, you know, close to nil. And we would hope to maintain that through continuing to be a leader and particular in data. And then the third piece is then looking at commercialisation. Well, there is an opportunity to partner with third parties to deliver new revenue opportunities. And in no particular order, do we think we can sell this data to some of our existing clients? Do we think there's an opportunity to sell this data to product issuers? So ETF issuers, for example, might like to see some of our very broad data, because remember, we sit across a very, very large part of the Australian market now, and we can identify trends across the market because of that data. So would product issuers find this data valuable? Would corporates find this data valuable? So say BHP, would BHP, for example, find it valuable to know by domicile, by state, by city, by demographics where their shareholders sit? Maybe, maybe not. We don't know, but we're about to find out. Investment banks, obviously, we don't service the big end of town investment banks, but big investment banks doing in particular corporate placements and deals, would they find some of this data valuable for us to be able to tell them where specifically to target? So there's some of the opportunities that we're looking at, and we're pretty excited about the data initiative. But taking it from the core pillar, this is something we had to do to improve efficiencies in our own business, and we can self-fund it via retiring heritage technology. The third opportunity is technology. We have a great technology business team in place. And we are implementing an agile workplace environment or way of operating, which we think is important. There are cost reduction opportunities, particularly post-CHESS replacement visibility. And while today we might think that there's better visibility, I would say there's potentially not better visibility. So, you know, that's going to be an interesting, outstanding question for us. But we run, at the moment, dual platforms. Let's be clear about this. We run our own technology platform that supports all our own execution and clearing capabilities. But we run a dual platform that supports third-party clearing. Third-party clearing, remembering, is where we clear and settle for stockbrokers, but they still execute themselves. So we take up the back end and do the manual work around clearing to clients' bank accounts and physically moving securities on CHESS, moving in on CHESS. That platform is a third-party platform made up of Broadridge, a very large US business, Iris components, and Agility Hub components. It costs us circa 4 to 5 million, maybe more per year to maintain that infrastructure. There is a big opportunity for us to collapse that and move it across and consolidate into, or put it all in our own platform. But we've been unable to do that around the CHESS uncertainty, because to do it, we would need to develop our own platform more to bring in third-party clearing. But if we had to do that prior to CHESS replacement, there was a question mark around whether that development would be redundant. So we have more work to do around this. We need to identify, we need to work with the ASX and work out what this announcement today means. We were hopeful that it would be give us more clarity. Unfortunately, it probably hasn't. And unfortunately, it means that we are probably going to continue to have to run dual platforms for some time. To put that back into the P&L perspective, you saw before, though, that we were showing an underlying EBITDA loss for the year of $4.2 million. If we could retire that platform tomorrow, it would put, we think, a minimum of $5 million to the bottom line. The flip side, of course, is that that performance was also impacted by market conditions. And you saw that our revenue was down by about $4 million as well. So in a perfect world, if market conditions were more robust and we were able to collapse these platforms tomorrow, the business would be turnkey profitable, my opinion, of $8 to $10 million. That's just the position we're in. We knew of this position, and it's one of the reasons why, when we acquired Pershing, we acquired it for such a favourable price. Just on tech, there are more opportunities to deliver tech to our clients, and we continue to identify those opportunities. And per the first point,
it's all ending. Their thing is unwinding in 3 years or whatever.
Sorry, someone's got their microphone on. Please, everyone, please mute. This is public. If you have your microphone on, we don't want to hear what you're personally doing and having for dinner tonight. So new technology continues to be an opportunity. We have clients identified. We continue to work for that. And again, one of the reasons why we're implementing an agile way of working within our technology group to more clearly identify and deliver projects. And goes to the final point there, reorganisation. So they're the three key initiatives for us across 2023. Across the top, the unknowns are obviously markets and CHESS replacement, and I think I've probably spoken to both those. We'll crunch on because I'm sure there are questions. Next page. Look, over the past few years, I think everyone is aware ESG is become, and it is increasingly become, a focus in Australia for corporate partners, clients, and all stakeholders, expecting us to have a strategy in place, an actionable plan around how we are an ESG compliant business. Very fortunately, we are able to integrate this with what we think is a very good technology implementation, and a company that's one of our first to come on platform. So we are developing and managing an ESG strategy. We're partnering with Givable as part of a broader risk management framework. And like I said, Givable is one of the first companies to come on board FCX. So we're incredibly excited about that. And we like Givable as a corporate, and we're going to continue to work with Givable. So what's it mean? It means through Givable, we'll be able to screen customers and suppliers to ensure our corporate ESG objectives at the headco level are aligned and and consider the broader corporate ecosystem. So it's a great partnership, and we're going to be able to provide more detail around that going forward. But I just did want to highlight that this is a key initiative for us, and fortunately fits very well with Givable coming on platform on FCX. Very briefly, FY23 outlook. Look, markets continue to be challenging. If you look at the graph across to the right, what it very clearly articulates is FY21 to 22 for these months. And if you look at those turnover figures, at a rough calculation, they are 25 to as high as 30% lower than they were last year. The impact is, we are obviously feeling that impact per cost reductions that we have made and being cognizant of that. And so we are closely correlated to that. And you saw that in our numbers for FY22. You saw that we had that miss of revenue, which was, less than 10%. But obviously we expect these markets and conditions to remain challenging. And so we're dealing with that on a day-to-day basis. But what we're doing is we continue to invest in technology. We continue to invest in FCX and data as a strategy. And the reason that they are our three primary initiatives is because they all move us away from being so correlated to the market. If you think about unlisted markets and what we're doing with FCX, it should be far more diversified and not correlated, obviously, to listed markets. So we're looking to build revenue away from correlation to markets. Data, likewise, another initiative for us to build revenue away from day-to-day markets transactional business. And then technology, again, we have opportunities to deliver technology. And very simply, think of it this way: if we can replace an Iris terminal or a Bloomberg terminal at any of our correspondents with one of our terminals, being a trade centre terminal, well, that is revenue, that's SaaS, that's subscription, that's not markets correlated, unless, of course, that firm closes down or loses a whole lot of advisors and cancels subscriptions. So, but that's what we're looking to do. All our investments are trying to move the business away from this sort of correlation that we have seen in the last 6 months in particular. And then finally, and I alluded to this before, we've had genuine engagement, both domestically, but importantly globally, around FCX and its ability to deliver what I call a more efficient marketplace. And so if you think about it this way, we think there's a big opportunity for us both domestically to demonstrate how an implementation of new technology can build a more efficient marketplace. And we're not going to be confrontational with incumbents, with the ASX and CBOs and others here, because historically we've been very supportive of CHESS replacement, and we will continue to be supportive because it will bring efficiencies to our business over time. However, if you were looking to build a market from scratch without all the touch points that an ASX has or other listed markets, what we're doing with FCX is the way that you would implement it to get the full benefits of a distributed ledger, tokenization of securities, cash on ledger, ultimately leading to atomic or real-time trading and settlement. And that to me is very exciting, because if you think about what we have a business here of circa 180 people supporting listed markets and outdated infrastructure that promotes T+2 settlement. Where we can use this capability to put more efficiencies into that world means we will be a more efficient organisation, whether that's from a people perspective over time, a technology perspective, or importantly, from a capital, liquidity and regulatory perspective. And so that's really the opportunity for us. So look, I'm going to pause for breath there. That's been a pretty solid session, and open up to any questions.
That was in the
Yeah, it was. Yeah, so it was. So the question, I believe, is clarifying the amount of cash that the business holds, and so the answer to that is 115,115. Thank you, Russell.
Very good. Any other questions? Feel free to come off mute if anyone wants to talk directly.
Should we stop sharing?
No, there's another one.
Yeah,
David,
maybe stop sharing now.
David, are you in discussions with the ASX on solving their problems all the time, or is it like a fluid situation? How engaged are you with those guys? And how hard is the problem? I mean, it seems like a quite a difficult problem to solve.
Pep, great question as always from you, and I've got to be a little bit careful as to how I answer this. Look, since the day that we envisaged what FCX could be and our role in capital markets in Australia, we've engaged with the ASX, and we've positioned it this way. We've said, listen, we're a supporter of CHESS, what you're doing with CHESS. We will always support that because it will bring efficiencies to that market. However, what we're going to do is build this private markets opportunity. And what we think it could demonstrate is what I call a life cycle of securities, an ecosystem where you take a very early stage company like FinClear was 5, 6, 7 years ago, put it through an infrastructure or capability like FCX, and then where it can grow up and potentially go into a full ASX IPO and listing. So very much a junior bourse or a feeder exchange, but again, building that ecosystem. And the way that I position it to the ASX was also, this could be a very good news story for you, because obviously we're trying to build a full ecosystem for companies to go early stage through to listing, but also we're implementing technology in a different way because we can, because we're not constrained by CHESS and all the touch points that CHESS has. So we can actually use that technology in private companies in a different application to demonstrate how this can build a more efficient ecosystem and could potentially translate over time into listed markets. Unfortunately, the ASX have not engaged with us as well as we would like on that. I think there's recognition and support for what we're doing, but I think it's fair to say they see too many conflicts, they see too many problems with what they're doing with CHESS, and they declined, regretfully, to fully engage with us. So, you know, what you will see now is we will become more proactive, we will become more vocal around FCX and how it can be the future for financial markets. So we're not launching FCX to displace the ASX, but what we are demonstrating is a new technology and capability that we think will be adopted globally over time. And we see sandboxes, we see we see environments being dialed up by regulators in other parts of the world, in Europe, UK and US, that are demonstrating this capability using distributed ledger capability. I think the regret here in Australia is, and this has been highlighted in the press, is that probably everyone's been a bit blindsided by relying on ASX and them delivering this solution. And the problem is that this solution has too many touch points, is too complicated, and really what the ASX, to my mind, should have been doing was working with FinClear to develop something like this in a smaller scale as a feeder market that could be adopted over time into public markets. Because it's my belief that competition for ASX and CHESS will not come from someone trying to recreate CHESS as it is today. It will come from someone being a big exchange or global CSD, adopting the technology and the processes that we're demonstrating with FCX and applying that to public markets. And we're seeing that, by the way, offshore with Deutsche Börse and Clearstream in Germany. We're seeing it in the US with a big implementation of digital asset into bond markets. We're seeing it in pilot programs I alluded to, sandboxes in ESMA in Europe and the UK. And we're looking at those as opportunities for us as well. And there's some of the opportunities. FCX today could be launched into one of the pilot programs or sandboxes in Europe or the UK when they're implemented next year as a solution. And that's an opportunity for us, and that's something that we'll be working on. Paul Massey has a question.
Yeah, Dave, the question is basically, you've said you're going to have 30 people onboarded by the middle of next year, but that strikes me still as a pretty small number. I mean, how scalable are you? I mean, are we talking about able to add on maybe 3,000 by the year after in terms of businesses and organizations?
Thanks, Paul. Yeah, great question. So the 30 is by the end of this calendar year.
Oh, sorry.
So we're on the hook to have 30 corporates on by the end of December. And we think that could be 100 or more by the middle of next calendar year. Productionizing this is both our opportunity and our core capability. Remember, what we're doing here is applying what we do at FinClear, which is very broadly across listed markets and capabilities, and using that infrastructure for FCX. It's one of our core advantages. The other core advantage is that we're regulated and we're a trusted counterpart. But if you think about it, we're regulated, trusted, but we also have a big machine here. And that big machine is increasingly turning its focus to productionizing clients coming on board FCX. And particularly given listed markets are off the boil a bit, means we have some capacity. So look, the other thing we're doing is working with one of the big accountancy firms, BGL, as that funnel at scale. So BGL sits over 700,000 unlisted companies as a technology provider for accountancy firms. And so we're linking into that. Now, if 700,000 is a big number, take 10% of that's addressable, 60,000 corporates. It's a big addressable number. The ASX, again, only has 2,500 companies on platform. We know that 2,500, or we know that half of those, 1,200, are subscale with a market cap of less than 50 million. They could potentially more comfortably, from a regulatory and cost perspective, sit on FCX. So we've got a big addressable market, and we're working very hard at productionising that.
So can I just
and investing in
David,
that capability.
David, can I just say, Paul, you know, the board is very keenly focused on making sure that we've got scarce resources, that we need to focus upon the things that can hit absolute scale. So when we started the business, we weren't interested in being a boutique provider of services. We needed to get to scale. We know that's all about financial services. So when we embarked on this strategy of FCX, we gated the management team to say, 1, prove up the technology, 2, prove up that you can now get people onto the platform, and 3, and you'll get released more funding, but 4, it's important for us to get to 2,000, 4,000, 10,000. And, you know, it's like when we started Afterpay. It was, you need to prove it up, you then need to get a flywheel, and you need to scale. We're not going to be a niche player in the provision of registry services. We just need to be the default for private companies. That should be the natural way by which they manage their register, and then everything else should come from that. So that's the reason why we've chosen this technology. That's the reason why we've embarked on this strategy. But, you know, if we can't get to scale for whatever reason, we're not going to be a subscale business in anything. And, you know, you can be rest assured that what we do, we then put a bullet into a strategy that wasn't getting to scale. So you should see, as a shareholder, us hitting scale numbers, because otherwise you just get stuck in that very high cost base positioning. So I think David and the management team are very focused upon achieving that scale by employing longer term technologies, by making sure we've got the right people in the right place, but also putting in, you know, gates that incentivise the management team to hit, you know, those targets.
Thank you, man. Thanks, Dave.
Thanks, David. And I'll just add to that briefly, Paul. One of the things that we're very cognizant of, and the reason that we're using the technology we've looked at competitors offshore. There are no competitors locally to our mind, but offshore. There's a very large business in the US called Carter X. And look, one of their problems has been their ability to scale. So we know for a fact that a recent transaction, a large transaction, took them months to actually finalise from a documentation issuance of share certificate perspective. What we are doing is using technology to really enable that scale and efficiency. And that's what we'll be demonstrating on Monday or early next week, when we demonstrate a real live on-platform event that will happen atomically in real time. Okay, we've got a question from Luke Rathborne. 2 questions, please. Large trade creditors. That's one for my CFO, Natasha.
Yep, I can take that one. Thanks for your question. So in the course of performing our execution, clearing and settlement services, we collect commission on behalf of our intermediaries. So, and that balance fluctuates in line with their activities, market activities, volumes, etc. So the way we reflect that commission payable at a period end is through trade creditors. So it's nothing sinister. It's just the amount of money that we happen to own, that we happen to owe those intermediaries for that month. hope that answers your question.
All right, come back, Lukey, if you want to follow up on.
I can't remember the what was on the cash side of things, the various buckets of cash, but were the cash buckets significant? I know it's 115 in total, but you know, cash flow wise, it's easy to cover those sort of, you know, 50 odd mil of trade creditors.
Yeah, because remember that we actually collect the cash from that intermediary's investor. So we have the cash on hand. We're not funding that ourselves.
Yeah, no worries. So are you able to bring up the balance sheet there so I can just see the various cash buckets
yeah.
on the...
Yeah, we can.
Thanks. And David, do you want to have a crack at number 2 there? Just any updates on IPO? Does FCX replace the need for an IPO, do you think? And just...
yeah, look, the two things. Obviously, capital markets are not great at the moment. Many would say capital markets are probably closed. Fortunately, we're in a position that we don't need to raise capital today. The flip side, of course, is that I'm incredibly optimistic about FCX and its capability, if and when we do need to raise capital, that is a far more efficient way for us to raise capital and will allow us to stay private longer rather than going to public markets.
Right. Yeah, so back to the cash there. Cash of 69 clearly covers the trade creditors of 54, but
yeah, so just to be
that's
clear,
a very different story cash-wise, isn't it? You know, if you net those off.
Yeah, so just to be clear, the entire 54.9 million is not commission payable, but that's the reason for the increase. So just to answer your question about why it's increased, that's why it's increased. There are other balances in there, as it says there, including security deposits that we hold from our intermediaries, which just we hold.
Yeah, no worries.
Thank you.
Thank you.
Okay, thank you. Go back to the...
So we can stop sharing, yep.
Go back to the tab.
I think John's put his hand up.
Any more questions? John, if you'd like to come off speaker, maybe see if your microphone works now.
Can you hear me there now, David?
Yeah, perfect, mate.
Thanks. I've moved off my computer onto the iPad and moved to the front porch. So just a question, David, given those volumes you showed for the first 4 months of this financial year compared with 21, when that is quite a steep reduction and which will be reflected pretty much in your own revenue. So I've got a question, perhaps through the chairman, as to would it be, given that the small numbers of shareholders, it'd be useful to have a look at your almost revised forecasts or revised budget figures for the first 6 months of this financial year and further into the completion of the financial year, because your revenues, it looks like to me, David, and this is putting FCX to one side, but what I call your core revenues, and I understand your points about 2 systems, you'll get some system savings, but what are your revised forecasts then for, say, 22/3? Because you're like many businesses of this type, the costs are pretty fixed and it's really hard to take them out. So I'd be interested as a shareholder to see that. And secondly, just an observation around FCX. I think the concept is a great one, and I think you probably need to get that permission to run some liquidity events, because I tell you this, at the small end of town, the clients are very reluctant to see the value of pure registry and pay accordingly. So, you know, we at Link always found it was really hard to make a bob at the small end.
Yeah, John, I think, listen, I might just have a quick go at that. So the first question is, totally agree. So the pricing is not around the registry. We think it's about the other services. The pricing on the registry is basically a service fee. We don't think that the revenue is going to be significant. It's going to be everything that then rolls off from that. So that's the other services, such as capital, such as corporate actions, ESOP schemes, and obviously capital raisings. So we think that you know, you're correct around that thesis. And that's the reason why we've been pricing in a way that it's not relied upon just generating fees solely from registry services. So the second point is around the forecast. I think you're correct. One of the reasons that we put that chart in around the retail, I think at the board, you know, our market is very closely correlated to our retail stockbrokers. So for us, that's one of the reasons why we asked, and David and the team were more than willing to readjust the cost base. So for us, you know, we're not forecasting revenues that are going to be up near the peaks that we had obviously in 21. We just don't think the conditions are right for that at the moment. So one of the reasons why we're obviously adjusting our cost base is reflective of our forward view about revenue is. Notwithstanding all of that, John, you know, it is so unpredictable. The last 3 weeks have actually been very strong revenue numbers, but previous to that in October, they were obviously, you know, quite difficult. But I'll hand it over to David.
Thank you.
Yeah, that's right, John. Look, we've tried to be proactive around this, manage our cost base. We're looking at other cost saves and efficiencies. So you're absolutely right. The flip side, though, of course, is our actual organic growth and client acquisition, we think will remain strong as well. And so to give you insights into that, you know, we do, even in this depressed market state, we are onboarding clients. One of the ones, I don't think we have a public announcement out yet, but the second largest fintech broker in the world. So everyone knows the name of the largest fintech broker being Robinhood. I'll give a gold star to anyone that can tell me who the number 2 is. You've got 5 seconds. No, Chairman, you don't count. 1, 2, 3, 4, 5. Okay, the second largest is.
Yes.
Who guessed?
No.
eToro.
No, it wasn't a good guess.
Oh,
But
Tom, you're close, but no cigar, mate. No, Tom Macy came up with eToro. It's actually Webull. Webull is we think the second largest global fintech broker. They are coming to Australia next year, and we have signed them on as a client from next year. Now, it'll be a slow ramp up, and again, I don't expect, you know, significant revenue, you know, John, into potentially, you know, FY23. But nonetheless, we are now being seen as the default house, so to speak, for fintechs to come to for market infrastructure solutions. And we are having significant discussions as well with other big banks and wealth platforms in particular. So one of the things that I've been very passionate about, some might say for the last 3 or 4 years, is called building a HIN platform, a direct investment HIN capability. All the big banks and bank platforms and the bigger independent platforms do not have a HIN capability. They all run custodial infrastructure. When I first launched FinClear back in 2015, I went and saw one of those wealth platforms, and they said to me, almost word for word, I don't know why you're bothering to do this. Direct investment HIN, stockbrokers are going the way of the dinosaurs. Everyone will invest through a wealth platform and a custodial infrastructure over time. And I went, okay, thank you very much. Happy to take that on board. I beg to disagree. I'll go off and do what I'm doing. About 6 months ago, that same wealth platform came back to me, and they actually even had the good grace to say, David, we remember that meeting and we remember what we said, and suffice to say, we think you're right. We think there is a place for HIN, direct investment, and we want to engage with you now around solutions. And so it's one of the big dynamics going on as well. If you think about what we're doing, we're providing direct investment solutions, HIN solutions. I view HIN as being a very early form of tokenization. It's a digital direct ownership capability. What we're doing with FCX is tokenizing unlisted securities. I actually think the world goes away from custody and more towards direct tokenization of securities facilitated by technology over time. So I actually think that, you know, in that context, there's a big opportunity for us. So long-winded, John, I know. Yes, our market, our business is correlated to markets. We're trying to diversify and move away from that. There's no doubt that will impact our FY23 projections. At the same time, though, organic growth of the business and client acquisition, I expect, will remain strong.
David, Luke again. Another question. Do you foresee, what was the timing around full functionality on the FCX platform? And do you see FinClear providing a liquidity opportunity for shareholders at an event such as this or future events?
Yeah, look, Luke, we're going to demonstrate pretty much full functionality in terms of a cap raise and capability on I'm hoping on Monday, with an actual live real-time capability. So just to give everyone some clarity, I will be real-time using my regular day-to-day bank account, either NAB or Macquarie. I will be real-time transferring cash onto FCX, and it will real-time, and I'm talking milliseconds here, appear in my wallet on FCX. I'm then going to take that cash, which is in a token form, and use it to invest in Givable. So the reason we wanted to highlight Givable as one of our first companies is we like it, but I also personally like it, and I'm going to be putting some cash in on platform to invest into Givable as a live demonstration on Monday. So what's that mean from our capability, Luke? I would like to demonstrate a liquidity event in FinClear. I don't think it'll be this side of Christmas, but I think there's the opportunity, you know, market conditions being a bit better, early next year, to do a on-platform FinClear, either secondary or potentially small primary if we want to demonstrate the capability. And I think that would be a great venue for us to demonstrate the additional value that we have added to FinClear.
Okay, thanks. So would you say early next year or?
Oh, Luke, don't try and tie me down to...
And gut feel, like markets aren't great, we know that, and private markets not great. But based on where... January's off the table.
January's off the table, mate. No one comes back until after Australia Day. So then you're talking about, you know, February, and then you start coming into other dynamics. So I would hope, you know, if there was an opportunity, February, March.
Great. And maybe there's a bit of appetite from, you know, small cap managers out there, or you know, private investors, instos, if you want to comment on that. But I know markets are tough at the moment in this space. But based on the assumptions when you raised that $15, or there was liquidity provided at $15, do you feel, even despite the current market environment, do you feel it's a better business now, and given those big cost savings that you've got out of the Pershing business?
Luke, 100%, I feel it's a better business. Obviously, we're being challenged by short-term revenue, as we've pointed out in that markets business. But the business today and what we've delivered with FCX, our vision for the future, the engagement that we're getting from offshore counterparts, the interest that we're getting from external investors, absolutely. What that translates into in terms of share price, I'm not going to guess, and I'm not going to be tied down to.
I mean, the reality is that we took on an elephant, we've actually chopped that up into small pieces. We've eaten it, we've digested it, we've now got the results that are sitting there in front of you. And before, we just couldn't say that. We were talking about the potential. Now we're talking about the reality of what we've been able to do. And I think you measure that not just by the numbers on the page, but you measure that by the engagement of our customers, as I said at the start. You know, clearly that, you know, they were very pleased that they've got a different provider. We have a very strong relationship with our banking partner, ANZ. You know, we've got a very strong relationship with a whole lot of other stakeholders. And I can say that's come about because we're just a much more significant business. So yes, it's a much better business. And, you know, I feel very good about saying that.
Okay, so look, guys, I think we're going to wind up because we're way over time here. The only final thing I'd like to point out, and I'll let Natasha talk to this, is over the course of the year, we did change auditors. And so we moved to KPMG. We were previously with Grant Thornton.
With Pitcher Partners.
Pitcher Partners.
Yeah.
We're before Grant Thornton before that. Yeah, we're
Yeah.
previously with Pitcher Partners. But I'd like to thank Natasha and the finance team in particular, because it was a huge project. If you think about what we were doing generally across the business, but then also undertaking almost a mid-term move from an auditor's perspective and getting consolidated results for a full year, it was a big undertaking. So, and also, I think, you know, Natasha, maybe you give just 10 seconds on how you think that went.
Yeah, absolutely. I mean, so KPMG were the auditor of the Pershing business that we acquired. So to that extent, we felt that they had some good background on our industry and at least the operation of that entity. And so that made them a natural choice. It was, as David said, it was a big undertaking to get them up the curve. Obviously, the FinClear group has some other offerings in the technology, in FCX, in data. We've got a lot going on. So it was a steep curve. But I think the outcome is very well. We had a large number of clean opinions. We obviously get opinions for our AFSL licenses. As an ASX clear participant, we have ASX returns. We have an MDA audit opinion. So look, you know, there's a lot to output, but it went very well. We got a very good outcome. So yeah, thanks to the team and thanks to them.
All right, terrific, guys. Well, and if there are any further questions, please feel free to come through to me directly, Natasha, or even David Hancock. But I think we're out of time for today and we'll wrap it up. Thank you, everyone, for your participation. Thank you, staff that I can see have dialed in. Thank you, board. And importantly, thank you, shareholders, all shareholders, for participating. I think it's been a great, obviously, I've enjoyed the interaction. Thank you, everyone.